Bitcoin is a new virtual currency system that's been gathering a lot of attention recently, and I thought I would do a series of videos where I really dive into the innards of Bitcoin and explain how it works in detail. And my plan for this first video in this series is to describe some of those mechanics at a high level. And then what I'll do in subsequent videos is dive a bit deeper into all of the underlying aspects that I touched upon within this first video. And my hope is that by the end of this video series, you'll know not only what a Bitcoin is, but you'll also understand the mechanics of how transactions are initiated. You'll see how verification occurs for those transactions, and you'll also learn what it means for someone to really engage in a process known as Bitcoin mining. And that may be a term that you've heard if you've had any interest in Bitcoin recently. Now, I do want to point out also that the Bitcoin scheme is fairly involved. It requires some time to really cover all of the relevant details, and to me, the best way to really wrap your head around a scheme like Bitcoin is to really suspend belief for a bit and get exposed to all of these relevant details. Now, you'll have a lot of questions along the way, but my hope is that by the end of this video series, all of the relevant stones will have been overturned and your questions will have been appropriately answered, but it might take some time to get there, okay? And in part, that's because I'll try to describe things in a way that's sensible, and that might involve leaving some details out until I can explain enough pieces of the scheme and then adding those details in as I go along so that you're not inundated with too many minor points and nuances along the way, but you get a feel for the overall system as I go through things. So with that, let me go ahead and just dive right in. And first of all, I do want to point out that Bitcoin has been described really as a decentralized currency because there's no real central bank or entity that's involved in generating or transacting Bitcoins. And in fact, what happens in the context of a Bitcoin is that all of the transactions really require what's known as a peer-to-peer network, a network of just individual hosts that essentially collectively agree on different aspects of how the protocol is implemented and used. Okay, and then Bitcoin itself is also referred to sometimes as a cryptocurrency. And by a cryptocurrency, I mean that we use a lot of cryptographic techniques in order to facilitate or to really enable Bitcoin transactions to take place. And I'll do separate videos on some of these techniques, but just take it at face value right now that it's decentralized and is a type of cryptocurrency. Now, I also want to point out that the term Bitcoin itself can in fact be a bit confusing. And in many ways, Bitcoin transactions don't really resemble traditional coin transactions so much as they represent really entries in some type of a global ledger. And by that I mean that let's say you have a transaction taking place, and let's say the transaction is taking place within or among two parties, and we'll call them Alice and Bob, which are traditional names that are used in many cryptographic protocols to describe the parties involved. And imagine that Alice wants to transfer, or really wants to assign, a certain number of Bitcoins that she possesses over to Bob, okay? And you can think of this transaction really as an entry in a ledger of some sort, okay? And I also want to point out before proceeding that even though I've used terms like Alice and Bob, what I really mean in the context of Bitcoin is not the actual identities in the physical sense, but really that Alice and Bob are identities in the Bitcoin system. And these identities are just, in actual implementation, are just collections of numbers that do not have to be tied with Alice and Bob's real world identities. So in that capacity, you can think of Bitcoin identities really as effectively being pseudonyms, okay, rather than real names. And the idea is that Bitcoin then becomes more of a pseudonymous protocol where people are addressed by their pseudonyms, and that provides some level of privacy to users who want to transact using the Bitcoin system, okay? Now, in a transaction between Alice and Bob, what Alice will basically do is specify a few different numbers. She has to specify how many Bitcoins she wants to allocate to Bob. So let's say Alice started off with 50 Bitcoins of her own. She might decide that she wants to give, let's say, 30 of these Bitcoins over to Bob, okay? And let's say she wants to have some number of Bitcoins returned back to her. So you have to specify, or Alice has to specify rather, how much change she's going to get. So in this case, let's say her change is going to be 18 Bitcoins for herself. And then the remaining 2 Bitcoins are going to be a transaction fee. And we'll talk about what a transaction fee means a little later, and I think I'll also dive into it in future videos, but it's basically an incentive for other nodes in the Bitcoin network to help Alice in essentially validating some of the details of this transaction for Bob. Okay? Now Alice will take these transaction details and apply what's known as a digital signature to these transaction details. And the digital signature is basically the mathematical analog of a traditional signature. It really binds Alice's identity to the details of this transaction. And by Alice's identity, again, I mean her identity within the Bitcoin system. And this binding is really done in a cryptographically strong way. Okay? Now the details of this transaction, once it takes place, are going to be broadcast out. So Alice is going to take these transaction details and effectively just broadcast them out to all the nodes in the peer-to-peer network that represent Bitcoin nodes. Okay? Now Bob, when he receives information about this transaction, he receives it over the peer-to-peer network, he'll probably sanity check some parts of the transaction. For example, he might check that the numbers work out correctly, that Alice, let's say, started off with 50 Bitcoins and is not trying to transfer more than 50 Bitcoins to him, and so on and so forth. And he's going to have some mathematical assurance because of some of the cryptography involved that some of these claims are accurate, that Alice, let's say, has the Bitcoins that she's claimed to possess, and that she's expressed an interest to assign those Bitcoins to him. But what he won't know yet is whether Alice has really tried to transfer those same Bitcoins to anyone else over the course of time, or maybe just prior to that point. And the way that we handle that situation, and by the way, I should point out that this concept of Alice trying to, let's say, spend coins twice, in the context of digital cash and electronic currency systems, this concept is known as double spending, and it's something you have to worry about when you have virtual currencies, because it's very easy for someone to just copy the numbers that represent this transaction and try to use them elsewhere. Okay? And the way we basically handle and reduce the risk of double spending is through a specific set of nodes in this peer-to-peer network who are known as Bitcoin miners. Okay, so you might have heard this term, Bitcoin miners. And the Bitcoin miners are basically specific individuals, specific nodes within this peer-to-peer network. And what they basically do is they take all of the transactions that they see, and remember, they're listening to all these transactions, not just Alice and Bob's, but other transactions that are taking place. And they'll take those transactions, and ultimately they will take those transactions and compile them into what's known as a transaction block. Okay, so it's basically a recording of all the previously unrecorded transactions. Okay, so if you think of a single transaction, let's say, as a ledger item, you could think of a transaction block as representing, let's say, an entire page in a ledger book. Okay, and these Bitcoin miners will also include in this block, in addition to all these unrecorded transactions, they will also include in this block a special transaction that's meant just for themselves, to basically reward themselves for the effort of doing this mining. Okay? Now, a transaction block will also contain an encoding of the previous transaction block. Okay, so there's going to be some level of continuity. And then Bitcoin miners will also include a specially crafted sequence of numbers associated with these transactions. And this sequence of numbers is known as a proof of work. Okay, and it's called a proof of work because it's something that's really hard to generate, something that requires a lot of effort to do, and that kind of makes it hard for just anybody to get involved with Bitcoin mining willy-nilly, but it requires that they really exhibit or exert some computational effort, basically in exchange for getting this extra reward of a payment, and also in exchange for getting this transaction fee that they're going to be promised by Alice to engage in this sort of work. Okay? And I'll talk about what proof of work protocols are in a separate video in more detail. Now, because each transaction block contains information about previous transaction, really what you end up having is not just a single block. You ultimately have what you can think of as a chain of transactions, and you can call this a transaction blockchain. Okay? And the idea is that as soon as a Bitcoin miner is able to construct a transaction blockchain containing all these unrecorded transactions and this proof of work, it'll broadcast the details of that chain out to all of the nodes, all the peers on that peer-to-peer network for Bitcoin. Okay? And then once the newly broadcast chain gets kind of verified and it meets the right properties, the nodes on the network are just going to go ahead and start using it, and they're going to start appending new transaction blocks to that chain. Okay? They're going to take anything that hasn't yet been processed and start incorporating it into the transaction chain that was broadcast out by the node who came up with the proof of work correctly. Okay? Now, this transaction blockchain, really, what we're going to be doing in the context of Bitcoin is the nodes are only going to consider the transaction blockchain that reflects the greatest amount of work to generate its contents. And again, there's this proof of work that I mentioned that is used to kind of determine or identify what work was involved in coming up with this transaction blockchain. Okay? And the one that's the longest is going to be considered sacrosanct within the Bitcoin system. And future miners are supposed to only work off of the chain that is the most work put into it. Now, what's remarkable here is that this whole process is decentralized. There is no bank or no centrally trusted entity that was actually involved in the transaction.
So let's start by answering the question, what is Bitcoin? And Bitcoin is very simply a decentralized digital currency. In other words, it's kind of like virtual cash or gold. And it's transferred person to person, which means that there's no bank or government control or prerequisites to be able to own or transfer Bitcoin. And the symbol for Bitcoin looks like this B with little hashes through it, or BTC, kind of like USD for US dollar. Now, Bitcoin is a cryptocurrency, and cryptocurrencies have been around since the 1980s. But there was a major problem called double spend. All of the prior digital currencies or cryptocurrencies have had the problem where if somebody spends a unit of that currency, it's been very difficult to tell if it's already been spent. And that's the biggest problem that Bitcoin has solved and why it has gained so much popularity. And the way that it does this is through its distributed peer-to-peer network, which works kind of like BitTorrents. And the first Bitcoin was actually issued in 2009 by someone apparently named Satoshi Nakamoto. And this is believed to be a pen name, and nobody really knows who started Bitcoin. So there will actually only ever be 21 million Bitcoins in circulation. And in 2009, we had the first Bitcoins that were released, and there is a predetermined amount of Bitcoins that are released every 10 minutes. And we'll talk about how that works in a later video, but just know that over the years, this will continue to happen until the year 2140. And Bitcoin is divisible down to the 8th decimal place. So kind of like the US dollar is divisible to the penny or 2 decimal places, you can almost infinitely break down Bitcoin to a very, very, very small amount. And the Bitcoin protocol or the Bitcoin network, the way that Bitcoin operates, since there's no central location that's governed by any specific country, it's very difficult and expensive to hack. And there's some numbers that say to even hack the Bitcoin network for 10 minutes would cost around $500 million. And so there's a lot of trust and a lot of vetting of the protocol and the network that has happened over the past few years. And it's basically controlled by the consensus of market participants. So again, no one government, no one person, or no one group actually controls the Bitcoin network, which is why it's gaining so much popularity. So why is Bitcoin so important? And there's some aspects of cryptocurrencies that I think show huge prospects for really changing the world. Let's look at this first fact that out of the 7+ billion people that live on the planet, about 6.5 billion people don't have access to basic financial and banking services like checking accounts or credit cards. And in the US alone, it's estimated that about 18% of people don't have access to these basic financial services. And it makes it very easy. Bitcoin makes it very easy for anybody without government permission or control to have access to virtual banking. And I think that's really going to change the world. The second fact that we'll look at here is since the 2008 financial crisis, fiat currencies like the US dollar, and if you're not familiar with what fiat currencies are, it's a currency like the US dollar that's backed by nothing but the trust that people have in the government. You know, back in the 70s, we were on the gold standard, and Nixon took us off of the gold standard, so now the US dollar is not really tied to anything. And I've always kept this 100 trillion Zimbabwe dollar as kind of a reminder of what can happen when governments get out of control by printing too much money. In the span of less than 2 years, the Zimbabwe government essentially devalued their currency to nothing. And there's a lot of people that are speculating that some of the major world's fiat currencies are going in that same direction. And it's kind of scary because right now the US dollar is the world's reserve currency, and we're just printing it like nobody's business. And so the way that Bitcoin handles this problem is that there is a predetermined set amount of Bitcoins that are going to be released over the years. And what that does is it's inherently designed to be deflationary and really control inflation. And the third kind of major problem that Bitcoin really handles is the fact that cross-currency purchases and transfers across borders, cross-country borders, are expensive and have a lot of friction, a lot of government red tape. And if you want to move millions of dollars, that costs a lot of money, where with Bitcoin, it's very, very inexpensive. And there's stories of people moving millions and millions of dollars for just a few pennies. So before we look at how Bitcoin actually has value, let's talk about what is money. And money is very simply any means for exchanging goods and services. And in recent history, we've used fiat currencies like the US dollar and gold as widely accepted forms of money. And there are primarily 4 properties that define what money is. Number 1 is it needs to be divisible. It needs to be able to be broken down into different parts or different sizes. Kind of like the dollar can be broken down into 2 decimal places, a penny or 10 cents or a dollar or up from there. Gold can also be broken down. You can have a bar or an ounce. There's different ways to break it down. The second is it needs to be durable. It needs to be able to stand the test of time. So if you have a bar of gold, if I put a bar of gold here on my desk, odds are it's not going to just evaporate into thin air. And even this $100 trillion Zimbabwe dollar isn't likely to just evaporate into thin air. Number 3 is it needs to be fungible, basically like a commodity. So one US dollar is equal to the value of another US dollar. They're interchangeable, kind of like on the futures markets where people trade, oranges or coffee or pig bellies or oil and gold. Each unit is equal to another unit. They're all created equal in their value. And then the fourth is it needs to be verifiable. You need a way to verify that it's real and not counterfeit. So Bitcoin does a very good job of answering those 4 properties of money. And let's look at some other ways that there's actually value derived from Bitcoin. Number 1 is it is limited and scarce, like gold. On planet Earth, there's only a set amount of gold. Just like there is a limited amount of Bitcoins. There will only be 21 Bitcoins that are ever mined, just like you can only mine a certain amount of gold. The second is it's decentralized. So we've mentioned this. There's no central government, which means it's a peer-to-peer network like torrents, and it can be anonymous. Now, there are some areas for improvement when it comes to the anonymous nature of cryptocurrencies, but for the most part, it is anonymous. It is also transparent, meaning the code and the structure, how the Bitcoin cryptocurrency network and protocol is built is transparent. Anybody can go and evaluate and look at the code, how this is built. And because it's been vetted by people way smarter than me for over 5 years, it's trusted. People place their trust in the Bitcoin protocol even more so than they're putting their trust in their own government, which is very interesting and why I think the whole cryptocurrency movement could really change the way that world leaders and governments and people look at money. It's also very easy to buy and sell. We'll talk about how Bitcoin works and how it's so easy just to move Bitcoins between 2 people. There's extremely, extremely low transaction fees, and it's irreversible. So merchants love it. There are no chargebacks and none of the problems that you have when it comes to taking credit cards. So it's important to keep in mind that Bitcoin is not backed by anything tangible. Just like fiat currencies, it's not on the gold standard. It's not backed by anything except for the trust that people have in the Bitcoin system. And the real value is determined by what people are willing to pay for it, which is why we've seen the price of Bitcoin go up so much over the past couple of years, because the demand has increased. And people place value in these 4 aspects of Bitcoin. Number 1, as we've talked about, the lack of government control and manipulation. no person who is elected into office can step in and contribute to hyperinflation. Okay, so protected from inflation. They have trust in the Bitcoin protocol, where it would cost over $500 million just to fool the system for about 10 minutes, and the anonymous nature of how Bitcoin works. So how does Bitcoin actually work? It's very simple. Let's say you take some money, somebody gives you cash, or somebody writes you a check, and you take that money to a bank and you deposit it into your bank account. Well, Bitcoin kind of works like this, where if somebody gives you Bitcoins, they are stored in a public ledger, and everybody has access to this ledger from the very beginning in 2009. Every transaction is actually recorded in this ledger, and sending and receiving Bitcoins is as easy as sending an email. It really is, and I'll show you how this works in a second. And so your coins are actually stored in wallets, and you have a few different kind of wallets. You can store your local hard drive wallet, so where your coins actually live on your computer. Number two, you can have paper wallets where you physically write down the codes that are associated to your Bitcoin and keep it off of the network. And number three, hosted online. So there are companies that are actually providing hosted wallets where you can access your coins from anywhere in the world. And that's where the security risk comes in. And in a later video, we're going to dive more into wallets and specifically how to buy and sell Bitcoins. So with Bitcoins, there's actually two parts to your Bitcoin account. Number one is your public key. So this is kind of like your account number or your email address. That's kind of how it works. And your Bitcoin key is actually made up of 27 to 34 alphanumeric characters. So it would look something like this, or somewhere around 30 characters. So this is an account number that you can actually give out to anybody who wants to send you Bitcoin. So say I wanted to send you 5 Bitcoins, you would give me your public key, I would type that in, and then shoot you over the Bitcoins. Now, where the protection comes in is your private key, which is kind of like your password for whenever you do online banking. You need to know your password to log into your online bank, right? Well, it's kind of similar with the private key, which is the password you need to access your Bitcoins in the account or in that public ledger. So it sounds complicated, but it really is pretty simple. So how do you get Bitcoins? There's really 3 ways to acquire Bitcoins. Number one, you can buy Bitcoins from a person. So you can come to me and say, Chris, I want to buy Bitcoin, and we'll look at the price of Bitcoin, and you give me dollars and I give you a Bitcoin. That simple. Or you can go to an exchange. There are websites like Mt. Gox, Coinbase, Bitstamp that you can go to, and this is where people meet to buy and sell Bitcoins from each other, kind of like the stock market. The second is you can barter. You can basically provide products or services in exchange for Bitcoins. And then the third is you can mine for Bitcoins. Okay, and this is where, if you recall a minute ago, I mentioned that Bitcoins are released every 10 minutes or so. There are miners out there who actually mine for these Bitcoins. And it works kind of like a lottery system where the more CPU power that you have and the more that you mine, the better your odds are of getting these Bitcoins for free. And the way that you do that is by running software on your computer. And in some later videos, I'll show you actually how to do this. So how can you profit with Bitcoin? Number one is if you mine, obviously you're getting these Bitcoins for free, and then you can sell them for whatever the market value is. Now, one thing I'll say is this is becoming increasingly more difficult. The more competition there is, the more computing power it takes to actually mine for these Bitcoins, and the more cost is associated, the more hardware you have to buy, and really the more electricity you have to pay for. And so before you say, look, I just want to start mining for free Bitcoins, you really have to do a cost analysis to figure out if it's going to be profitable or not. Okay, and the second way, which is my favorite way, is to invest or trade in Bitcoins. And you've probably heard a lot around, is Bitcoin a bubble? There's a lot of speculation, and prices have increased dramatically over the past couple of years. And so we'll talk about your options here, but I think the whole buy and hold mentality is very risky. Anytime that you say, look, honey, tonight I heard on 60 Minutes that Bitcoin, it's the new thing, it's going to take over the dollar. Let's just go ahead and buy some Bitcoins at whatever the market price is right now. That's a very, very risky strategy, as we'll talk about here in a second. My favorite approach to this is short-term trading. That's what I do. For over a decade now, I've been a professional trader in the stock and the futures markets, and I see a lot of opportunity to actually make money trading Bitcoins. And over the past few weeks, I've actually made some very, very nice calls and profitable trades in the Bitcoin space. Now, the third option that you have is if you're a merchant, if you sell products or provide services, what a lot of people are doing is they're offering discounts to people who want to pay for products or services in Bitcoin. So if you're somebody who sells cups, and you say, okay, the value of a cup is $1. Well, I know that if I expect the price of Bitcoin to go up over the next few years because of the limited supply, then I can actually take a discount. So you can either buy this cup from me for $1, or you can give me 50 cents worth in Bitcoin, so I'll accept that as a discount. That's what a lot of people are doing. And recently, people have been purchasing homes with Bitcoin. They've been purchasing Ferraris and Lamborghinis with Bitcoin. And recently, a lot of big merchants online have also started to accept Bitcoin. So this is a really exciting time in history to be a part of this cryptocurrency movement. So let's talk a little bit about Bitcoin speculation. Recently, Bitcoin has increased in value over 10,000% over the past couple of years. And through the rise in price, we've also seen many crashes in price of over 50%. But something to keep in mind, as of the time that I'm recording this video, prices recovered after each crash. So there's a lot of people that are speculating and saying, oh, Bitcoin's a big bubble, don't chase it, which I agree with. And as a professional trader, I am a huge proponent of not chasing what the herd is doing. We saw this in the housing bubble of the early 2000s. And even a couple of years ago in 2011, we saw that with the gold bubble. People flock to an asset or an investment vehicle that drives prices up, kind of like tulip mania, right? Some of you probably have heard about that. But the idea is to just understand if you're investing in something that is going to have long-term value. And there's a big question that I think will determine if Bitcoin is actually just a bubble or a fad, which I don't think it is. But the big question here is, will Bitcoin become widely accepted as a form of payment and a store of value? In other words, will the mass majority of people in the world use Bitcoin as a means of exchange over other currencies, fiat currencies like the dollar? And will they see value in it? Will they use it as a store of value, kind of like they look at gold? If that remains true in the near future, I think the prices of Bitcoin will stay very, very valuable. Now, let's go ahead and look at some recent bubbles in the price of Bitcoin. Here in June of 2011, this was kind of the first little bubble that we saw, where Bitcoin's prices went from about 50 cents to $32 in about 60 days, and then over the course of a few months, crashed back to $2. So this is kind of where the first, excitement of Bitcoin came in. A lot of the early adopters who had Bitcoins for free or at very, very low prices were able to cash out around $32, and then you can see it eventually faded back to $2. And then in April of 2013, we saw another big bubble where we went from about $35 up to $266, and then in the span of a few days crashed back to $50. And then that even recovered to the bubble of November 2013, where price went from $100 up to $1,200, and then has since crashed below $400. So it's important to keep in mind that bubbles are relative, meaning if we look at these past two bubbles, the first one from 2011 and then early 2013, you notice that in hindsight, after this big spike, these little bubbles just seems like little blips on the map, right? And so the question is, over the next few years, will the $1,200 price be the all-time high? And will this crash and then eventually fade out? Or will there be many more consecutive bubbles over the next few months and years? That's just something that nobody knows. And so I want to just give you a little bit of advice when it comes to speculation, because this is what I do. Number one, don't chase emotional buying. This is why so many people lose money in virtually every market, be it the stock market, the futures market, the housing market, now the Bitcoin market. It's when people chase emotional rises in price. Making money in the markets is all about anticipation and understanding mass human psychology. And I always like to do the opposite of the herd. When everybody's panicking, I like to look for opportunities to buy, right? When everybody is having bullish exuberance where they're really happy and it's driving the price of a market up, I get skeptical and I look for reasons to sell. And there's an old cliche quote by Warren Buffett that says, when people are scared, be greedy. And when people are greedy, be scared. And I think that applies to every market and especially in Bitcoin. Another thing is you want to consider the risks of Bitcoins and your goals, because Bitcoin is just an experiment. This is really the first successful cryptocurrencies. And right now, there's over 100 what we call altcoins or alternative cryptocurrencies. And so we don't know if in the long term, if Bitcoin is going to be kind of emerge or evolve to be the sole and most trusted currency. So you have to keep that in mind. And also, I wouldn't recommend trading with Bitcoin, or investing in Bitcoin with money you can't afford to lose, because there are some significant risks with Bitcoin that we'll talk about here in a second. And the last question that I kind of want to propose here is day trading or is short-term trading really riskier than the buy and hope mentality? My thesis is, and this is what I do every day, I come into the markets and I say, I want to have predefined trades that I'm looking for that I think have a high probability of success, that I can control my risk and really predetermine where my profit targets are and where my risk, where I would stop out or take a loss. I think approaching the markets from a very mechanical and mathematical approach is a better way to control risk than say, honey, I just want to buy in the stock market, or I just want to buy Bitcoin and hope it goes up for a few years. If you lived through the financial crisis of 2008, you probably experienced that pain. I know a lot of people that were very, very bullish on the markets in 2007, and you had idiots like Kramer on CNBC telling people the market's going great, everybody needs to buy at these all-time highs, and then a few months later the markets were down and people saw their retirement accounts fall by 50%, and then they sold at the bottom. They panicked. They thought the American economy was going to shit, so they sold out, and then they missed the 4-year bull market that happened after that. And so it's just my job here as kind of a trading educator to help people break away from the herd mentality and to see things for what they really are. So let's talk about some of the risks of Bitcoin. I think probably the biggest risk, a lot of people think that actually governments or political intervention is the biggest risk. I think an even bigger risk is bugs in the code or problems with the Bitcoin protocol that lead to a complete lack of confidence in Bitcoin. Something that could happen, if Bitcoin ever got hacked or if people ever said, look, we can't trust the Bitcoin protocol, you could have a flight from that currency and see it crash to almost zero. I think that's a very real risk, but I think the probabilities of that happening are very, very low. That's why I'm overall bullish in Bitcoin, and I actually believe that Bitcoin, or at least cryptocurrencies, is going to change the world. And then the third is competing cryptocurrencies. Again, there's over 100 alternative coins right now. If one of those coins solves a problem, a big enough problem that Bitcoin doesn't right now, then everybody could transfer into that coin. So that's yet to be seen, and be very skeptical of anybody who says that they know what's going to happen with Bitcoin. Anybody who owns a lot of Bitcoin is probably really bullish on Bitcoin and wants to see it succeed. Anybody who's a hater or feels like they were late to the game or doesn't quite understand it, they might be naysayers without truly understanding the movement that's happening right now. So just educate yourself and look at both sides equally.
Bitcoin, simply put, is a unit of currency that is traded like a commodity. So it's a little bit like gold. It is what we call a virtual or a cryptocurrency. Meaning the value is derived by math and what the market will bear. So basically, for lay people or people that are kind of just now hearing of Bitcoin, Bitcoin is an alternative to any other form of currency that you can trade and buy things with online and increasingly in person.
How does Bitcoin's differences from other currencies make it more or less worthy of investment?
Yeah, again, another complicated question. The differences, the pros and cons of Bitcoin, and put it that way. So the pros are that it is not what is called a fiat currency. That is, its value is not derived from like a government or a quasi-government agency. With the Federal Reserve can issue in America can issue additional dollars, and that has a significant effect on the value of a dollar in America, whether it's for the purposes of a bailout or controlling inflation or deflation. Bitcoin doesn't have that. There's a set number of Bitcoins that could possibly exist in the world thanks to the mathematical equation that creates them. So there will always be, it's like gold, there's a set amount of gold in the world. And, because of that, the price of gold will always go up. But it's the same with Bitcoin. It's called a deflationary currency. That's kind of the pro for a lot of people. It's also the fact that it's deflationary is a con if you're a Keynesian economist. If you think inflation is a good thing, then you think Bitcoin is a bad thing. Another pro is that it's not controlled by the government, so you can't have a situation like what occurred in Cyprus last week, and what was thought to have been occurring in Spain, which is where, to prevent an economic collapse, the government decided they were going to take some money out of everybody's bank account to pay off a bailout. And to prevent monetary collapse from happening. So that can never happen with Bitcoin because it's not centrally controlled, and a Bitcoin resides on whatever device you store it on, or it can even reside on a piece of paper since it is part of a math equation. You can actually download your Bitcoins to your mobile phone, copy the appropriate hex keys or mathematical keys that unlock your wallet, write them down on a piece of paper and put that in a safe, and nobody can get to it unless you open that safe and give them access. So it's a very secure currency, but there are some cons to it as well. So if you trust your keys and your wallet to an online provider, that online provider can be hacked. And if that online provider is hacked and your Bitcoins are stolen, just like if they're stolen from a bank, they can take physical possession of it. Unlike money, it's not FDI insured, like a U.S. money. It's not FDIC insured in any shape or fashion. If those Bitcoins are stolen, you're not getting them back. It's just as if they had stolen uninsured gold from you.
Just as the U.S. has the dollar, Japan has the yen, and the U.K. has the pound, the internet has the Bitcoin. Bitcoin is digital money used directly between people anywhere in the world to buy online goods and services. To get started, download the Bitcoin wallet. Like a real wallet, it stores your Bitcoins and is used to send and receive payments using unique addresses. Anytime a transaction is made between Bitcoin users, it's recorded on a publicly shared log called the blockchain. These transactions are checked and confirmed by miners. Miners are essentially people with powerful computers who, in exchange for newly created Bitcoins, use Bitcoin software to verify that transactions are correct. With thousands of miners contributing, transactions run smoothly, and the network is constantly secured. Thanks to miners and Bitcoin's large network, no coin can be reproduced or double spent. Cryptography is used to make it impossible for anyone to spend funds from another user's wallet, and can be used to encrypt a wallet so that it can't be used without a password. This type of security is also used for credit card transactions and electronic bank transfers. There is no company or central bank controlling Bitcoin, so it cannot be inflated like the dollar. In fact, the embedded code has been preset so that only 21 million Bitcoins will ever be in circulation. To ensure a steady rate of distribution, Bitcoin production was modeled after gold mining. Just like mining for gold grows increasingly difficult over time, so does creating new Bitcoins. Right now, 25 Bitcoins are generated every 10 minutes. This rate will halve every 4 years until the final Bitcoins are created. in 2140. And no central bank can add trillions more to the system for their own advantage and destroy its value. One way to get bitcoins is by mining them. But since that requires specialized equipment and time, most of us buy them. Several exchanges exist online where you can buy bitcoins and cash out your bitcoins for major currencies. There are currently 50,000 bitcoin transactions per day. Over 1,000 online stores accept them as payment, and the bitcoin market has exploded from $50 million to $1.2 billion in only a year. And these numbers are growing.
Bitcoin is a digital currency which aims to do away with all the problems we have paying for things online. You may think that the system we have is pretty good. But everything we buy today has to go through a bank or credit card company who take a cut of the transaction and who rely on our trust that they'll do everything right. After a while, those payments start to build up. And added to that is security. You have to trust your card company to keep your details safe. Many people have tried to work out how to have a payment system without that middleman. But then there's another problem. How do you prove that you've paid for something? Or even that you have that money at all, without someone vouching for you? It's so serious it has a name, the double spending problem. Then, in 2008, a solution was offered by an anonymous programmer going by the name of Satoshi Nakamoto. Nakamoto left a paper on a popular cryptography blog which proposed a system of currency that solved all of these fiddly problems. His proposal was that instead of a bank or credit card company recording every transaction in one central ledger, all of the users would record all of the transactions at the same time. As a result, any attempt to fool the community would be noticed and the payment rejected. No one user, government, or bank can force a fee on a payment or control its flow. The result is a cheaper, quicker, and easier way to spend money, even across national borders. So this is Bitcoin, and it's already starting to have an impact on people's lives. Within months of the proposal, it was being used to buy and sell goods, although not always from the most scrupulous of traders. But it's not all shady businesses. Some shopping sites take it. You can buy pints in London and even pay for your university tuition. As you might have heard, there are problems. While some are profiting from getting involved early, others are losing out from this volatile and young market. And people are founding companies to buy up lots of bitcoins. But as it's designed to have a limited amount ever in circulation, that might cause problems down the road. There's so much uncertainty around Bitcoin. Some people genuinely think this is the future. Others are terrified it could destroy our economy. But many from both sides agree that if we could get Bitcoin to work, or something like it, if we can trust a digital currency to work without the middlemen, then the way the world economy functions could be transformed for the better.
Bitcoins are digital currency. It's virtual money that can be transferred from person to person online without a middleman. That means no banks and their transaction fees. The cryptocurrency was created in 2009 by someone under the alias Satoshi Nakamoto. No one knows exactly who that is, and that's the point. Bitcoin is all about being anonymous. The real names of buyers and sellers are never revealed, which has made it the go-to currency for illegal sales of things like drugs and hitmen. Some legitimate companies accept it as payment now too, and one couple is even making a documentary about living off bitcoins alone.
It's a digital currency.
It's a what?
The value of the currency fluctuates. A lot. And the world's largest site for changing bitcoins into real dollars suddenly shut down. More than $300 million worth of bitcoins reportedly vanished. And unlike bank accounts, there's no government-backed insurance.
I'm both annoyed and worried. It seems that I've lost all of my money.
A major Bitcoin sell-off ensued, But analysts disagree about how much this will shock the digital system.
When something like this happens on what used to be the largest exchange, investor faith in Bitcoin goes down.
Is it just a growing pain?
How are you paying? Bitcoin.
Or the end of the Bitcoin as we know it? That's the million-dollar question.
Constant bank supervision and endless charges have been inevitable elements of your local or international money transactions. Not anymore. Bitcoin is the key to your financial freedom. It is a decentralized virtual currency, which means you no longer have strict regulations, high fees, or limits on your transactions. Bitcoin enables you to transfer money worldwide by peer-to-peer network without involving a central authority or clearinghouse. All the transactions are confirmed by the network itself, so your Bitcoins can never be frozen. It doesn't matter where you live or how much you earn. You can easily participate in this global financial system using your computer, smartphone, or any internet-equipped device anytime you want. Bitcoin is very user-friendly and treats everyone equally. Think of it as gold, but actually it's better. You can send Bitcoin via the internet, split it into many pieces, and carry it anywhere you go. Or, if you wish, you can exchange it for dollars, euro, yen, and other regular currencies 24/7. The rate is determined by supply and demand. Therefore, the fluctuation risks are determined solely by free market forces. The final number of Bitcoins is limited. In the future, there will only be 21 million Bitcoins, so the value cannot be inflated. Paying by Bitcoin is similar to the way we pay by cash, because you don't have to disclose any personal information when making a transaction. But at the same time, it is different, as you don't have to meet the seller in person in order to purchase something. Each Bitcoin user gets a generated public key, a public address similar to your email for receiving mail. Every single public key has a matching private key, which is proof of ownership of the Bitcoins. Anyone checking the public key can see how many coins are in the jar, but you have to have the private key to take the money out. It has never been so easy to protect your Bitcoins. Just keep your private key in your electronic device, written down, or just remember it. Bitcoin offers safe and cheap global transactions that are really fast and irreversible. Take a closer look at how it works. Let's say Annie wants to transfer 2 Bitcoins to James. She starts a free open source application known as Digital Wallet where she keeps her Bitcoins. Then she enters James' public key and the Bitcoins start their journey. When the Bitcoins are transferred from Annie to James, they have to be included in the blockchain, a shared public ledger that keeps a log of every single transaction ever made. A process called mining is used to confirm Annie's transaction. Miners are Bitcoin users, just like Annie or James, who run free mining applications to approve new transactions by solving a difficult mathematical puzzle. In return for using their computer resources, the miners are rewarded with a new Bitcoin. After Annie's transaction is approved by 50% of miners, James will be happy to find 2 Bitcoins in his digital wallet. Bitcoin is gaining more trust and new users every day. Many companies are starting to accept this new virtual currency for their goods and services. You can spend your Bitcoins on books, games, and coffee, or even buy a banjo. More questions? Look no further. SpectroCoin provides Bitcoin exchange solutions for all EU residents via the SEPA network and localized bank transfers along with international wire transfer capability. This grants fast access to the Bitcoin network. Using SpectroCoin allows users to create a free Bitcoin e-wallet, hold and spend Bitcoins without downloading any software. If you are a merchant and wish to accept Bitcoin, SpectroCoin will help you integrate Bitcoin into your daily business. SpectroCoin, your brand new financial lifestyle.
The goal of this video is to explain how Bitcoin works under the hood to give a clearer idea of what it really means to own, send, or mine Bitcoins. First, a brief high-level overview of what Bitcoin is. At its core, Bitcoin is just a digital file that lists accounts and money like a ledger. A copy of this file is maintained on every computer in the Bitcoin network. These numbers don't represent anything in the physical world. They only have value because people are willing to trade real goods and services for a higher number next to their account and believe others will do the same. The numbers only have value because we believe they have value, just like any other fiat currency. To send money, you broadcast to the network that the amount on your account should go down and the amount on a receiver's account up. Nodes or computers in the Bitcoin network apply that transaction to their copy of the ledger and then pass on the transaction to other nodes. This, with some math-based security, is really all there is, a system that lets a group of computers maintain a ledger. While this may sound similar to the way a bank maintains a ledger, the fact that the ledger is maintained by a group rather than a single entity introduces a number of important differences. For one, unlike a bank where you only know about your own transactions, in Bitcoin everyone knows about everyone else's transactions. Also, while you can trust your bank, or you can at least sue it if something goes wrong, in Bitcoin you're dealing with anonymous strangers, so you shouldn't trust anyone. The Bitcoin system is amazingly designed so that no trust is needed. Special mathematical functions protect every aspect of the system. The rest of this video will explain in detail how Bitcoin allows such a group of strangers to manage each other's financial transactions. At a basic level, for Alice to send money to Bob, she simply broadcasts a message with the accounts and the amount. Send 5 Bitcoins from Alice to Bob. Every node that receives it will update their copy of the ledger and then pass along the transaction message. But how can nodes be sure that the request is authentic, that only the rightful owner has sent the message? Bitcoin rules require a kind of password to unlock and spend funds, and this password is what's called a digital signature. Like a real handwritten signature, it proves the authenticity of a message, but it does so through a mathematical algorithm that prevents copying or forgery in the digital realm. Unlike a simple static password, a completely different digital signature is required for every transaction. Keep in mind that in Bitcoin, you're dealing with complete strangers, so you never want to reveal a password that could be copied and reused by someone else. A digital signature works by utilizing 2 different but connected keys, a private key to create a signature and a public key that others can use to check it. You can think of the private key as the true password and the signature as an intermediary that proves you have the password without requiring you to reveal it. Public keys are actually the send to addresses in Bitcoin, so when you send someone money, you're really sending it to their public key. To spend money, you must prove that you're the true owner of a public key address where money was sent, and you do that by generating a digital signature from a transaction message and your private key. Other nodes in the network can use that signature in a different function to verify that it corresponds with your public key. Through the math behind the digital signature, they are able to verify that the sender owned a private key without actually seeing the private key. Importantly, because the signature depends on the message, it will be different for every transaction and therefore can't be reused by someone for a different transaction. This dependence on the message also means that no one can modify the message while passing it along the network, as any changes to the message would invalidate the signature. The math behind this is fairly complex, and while I won't try to explain it fully now, here are some topics you can Google to get started: elliptic curve digital signature algorithm and mathematical trapdoor. More at the end of the video. So far, we know that digital signatures are used to ensure a transaction is authorized, but I've oversimplified how nodes in the network keep track of account balances. In fact, no records of account balances are kept at all. If you don't keep track of how much money any given person has, how do you know if they have enough to send to someone else? Instead of balances, ownership of funds is verified through links to previous transactions. Here's how this works. To send 5 Bitcoins to Bob, Alice must reference other transactions where she received 5 or more Bitcoins. These reference transactions are called inputs. Other nodes verifying this transaction will check those inputs to make sure Alice was in fact the recipient, and also that the inputs add up to 5 or more Bitcoins. Let's look at a real transaction to see this in practice. This transaction references 6 inputs for a total of 139.6 Bitcoins. In the output section, notice that there are 2 lines. The first one of these is actually going back to the sender as change for the transaction. A simplifying rule states that each input must be used up completely in a transaction. So if you're trying to send an amount that doesn't exactly match one of your inputs, you need to send any remaining amount back to yourself. Through these reference input linkages, ownership of Bitcoins is passed along in a kind of chain, where the validity of each transaction is dependent on previous transactions. But how can you trust those previous transactions? You can't, and you should check their inputs too. In fact, when you first install Bitcoin wallet software, it downloads every transaction ever made and checks each one's validity all the way back to the very first transaction. Remember, you're dealing with complete strangers, so it's important to verify every transaction for yourself. This process can take over 24 hours, but it only needs to be done once. Once a transaction has been used once, it is considered spent and cannot be used again. Otherwise, someone could double spend an input by referencing it in multiple transactions. When verifying a transaction, in addition to the other checks, nodes also make sure that inputs haven't already been spent. To be explicit, for each input, nodes check every other transaction ever made to make sure that input hasn't already been used before. While this may seem time-consuming, as there are now over 20 million transactions, it's made fast with an index of unspent transactions. So instead of a ledger of balances, Bitcoin nodes keep track of a giant list of transactions. Owning Bitcoins means that there are transactions in this list that point to your name and haven't been spent, or in other words, used as inputs in other transactions. One interesting consequence of this ownership structure is that figuring out your own balance requires iterating through every transaction ever made and adding up all your unspent inputs. Another interesting note about transactions is that the system can support more complex ones than simply sending funds to one person. You may have noticed a cryptic-looking line of text in the output shown previously. It turns out that outputs are more like puzzles to be solved rather than simple to addresses. Rather than emailing, sending money in Bitcoin is more like putting money in a public locker and attaching a math puzzle that must be solved to open it. The puzzle is defined using a special scripting language, and while it's typically designed so that only a single owner of a public key can solve it, more complex conditions are possible. For instance, 2 out of 3 signatures could be required for an escrow-based transaction. Another example is the very first Bitcoin transaction ever made, which was a puzzle that anyone could solve. While most Bitcoin software hides the scripting layer for you, you're free to write your own software and claim conditions, although this can be risky. Over 2,600 Bitcoins were lost in one batch of transactions due to a malformed address. This highlights an important part of Bitcoin. As there is no bank or credit card company you can appeal to, any user error mistakes can result in permanent loss of Bitcoins, and not just from your own account, but from the Bitcoin economy overall. If you lose your private key, any funds associated with the corresponding public key will be gone forever. Because people will likely lose private keys due to hard drive crashes and insufficient backups, this means the Bitcoin currency will eventually be a deflationary one. Before explaining the final piece that secures Bitcoin, mining, I want to highlight a few points about anonymity in Bitcoin. If you access Bitcoin through a Tor network that hides your IP address, you can use Bitcoin without ever revealing anything more than your public key. And to avoid someone linking your transactions together, remember they're all publicly stored on every computer, you can generate a new public key for every incoming transaction. It is possible, however, to inadvertently link public keys together. In the transactions shown earlier, 6 input transactions were used as sources, and despite the fact that all those inputs were sent to different addresses, they all became linked in that transaction. The sender proved that he owned all of those addresses by supplying the digital signature to unlock each one. Researchers have in fact used these links to study Bitcoin user behavior. You might think that generating a public key receiving address could potentially create a link to your true identity, but even this step is anonymous and amazingly can be done with no connection to the network. You simply click a button in your wallet software and it randomly generates a new private and public key. Because there are so many different possible addresses, there's no reason to even check if someone else already has that key. Compare this to signing up for an email address where almost everything you might try has been taken. In fact, if you did guess someone else's key, you would have access to all their money. This is the total number of possible Bitcoin addresses. These large numbers protect the Bitcoin system in several ways, so it's useful to try to appreciate just how big they are. Some estimates for the number of grains of sand in the entire world are around 7.5 million trillion. Now imagine that every grain of sand represented an entire other Earth of additional grains, and you're still much smaller than the possible number of Bitcoin addresses. Let's recap Bitcoin's security so far. By verifying the digital signature, we know that only the true owner could have created the transaction message. And to make sure the sender actually has money to spend, we also check each referenced input, making sure it is unspent. But there is still one large security hole in the system that can make this unspent check unreliable, and this has to do with the order of transactions. Considering that transactions are passed node by node through the network, there's no guarantee that the order in which you receive them represents the order in which they were created. And you shouldn't trust a timestamp because someone could easily lie about the time a transaction was created. Therefore, you have no way to tell whether one transaction came before another, and this opens up the potential for fraud. A malicious user, Alice, could send a transaction giving money to Bob, wait for Bob to ship a product, and then send another transaction referencing that same input back to herself. Because of differences in propagation times, some nodes on the network would receive the second double spending transaction before the one to Bob. And when Bob's transaction arrived, they would consider it invalid because it's trying to reuse an input. So Bob would be out both his shipped product and his money. Overall, there would be disagreement across the network about whether Bob or Alice had the money because there's no way to prove which transaction came first. In light of this, there needs to be a way for the entire network to agree about the order of transactions, which is very much a daunting challenge in a decentralized system. Bitcoin's solution is a clever way to both determine and safeguard the ordering through a kind of mathematical race. The Bitcoin system orders transactions by placing them in groups called blocks and linking those blocks together in something called the blockchain. Note that this is different from the transaction chain we discussed earlier. The blockchain is used to order transactions, whereas the transaction chain keeps track of how ownership changes. Each block has a reference to the previous block, and this is what places one block after another in time. You can traverse the references backwards all the way to the very first group of transactions ever made. Transactions in the same block are considered to have happened at the same time, and transactions not yet in a block are called unconfirmed or unordered. Any node can collect a set of unconfirmed transactions into a block and broadcast it to the rest of the network as a suggestion for what the next block in the chain should be. Because multiple people could create blocks at the same time, there could be several options to choose from. So how does the network decide what should be next? We can't rely on the order that blocks arrive because, as explained with transactions above, they may arrive in different orders at different points in the network. Part of Bitcoin's solution is that each valid block must contain the answer to a very special mathematical problem. Computers run the entire text of a block plus an additional random guess through something called a cryptographic hash until the output is below a certain value. A hash function creates a short digest from any arbitrary length of text. In our case, the result is a 32-byte number. Here are some examples of the specific hash function Bitcoin uses, SHA-256. Note how much the output changes in result of a single extra period at the end of the third example. The output is completely unpredictable, so the only way to find a particular output value is to make random guesses. It's very much like guessing the combination to a lock. You might get lucky on your first guess, but on average it takes many guesses. In fact, in Bitcoin, it would take a typical computer several years of guessing to solve a block. With every computer in the entire network all guessing numbers, it takes about 10 minutes on average for someone to find a solution. The first person to solve a math problem broadcasts their block and gets to have their group of transactions accepted as the next in the chain. The randomness in the math problem effectively spreads out when people find a solution, making it unlikely that two people will solve it at the same time. Occasionally, however, more than one block will be solved at the same time, leading to several possible branches. In this case, you simply build on top of the first one you received. Others may have received the blocks in a different order and will be building on the block they first received. The tie gets broken when someone solves the next block. The general rule is that you always immediately switch to the longest branch available. The math makes it rare for blocks to be solved at the same time, and even more rare for this to happen multiple times in a row. The end result is that the blockchain quickly stabilizes, meaning that everyone is in agreement about the order of blocks a few back from the end of the chain. The fact that there's some ambiguity in the end of the chain has some important implications for transaction security. For instance, if your transaction finds itself in one of the shorter branches, it will lose its place in line within the blockchain. Typically, this just means it will go back to the pool of unconfirmed transactions and be included in a later block. Unfortunately, this potential for transactions to lose their place opens the door to the very double-spend attack that was our original motivation for an ordering system. Let's look at how a double-spend attack would work in the system described so far. A fraudster, Alice, sends money to Bob. Bob then waits for the transaction to get confirmed into the blockchain and then ships a product. Now, because nodes always switch to a longer branch, if Alice can generate a longer branch that replaces the transaction to Bob with one to someone else, his money will effectively get erased. Bob's transaction will initially get tossed back into the unconfirmed pool, but since Alice has replaced it with another transaction that uses its same input, nodes will now consider Bob's transaction invalid because it's referencing an already spent input. So how does the ordering system prevent Alice from defrauding Bob? You might think that Alice could pre-compute a chain of blocks to spring on the network at just the right time, but the math puzzles in each block actually prevent this. We need to look a little deeper into the cryptographic hash explained earlier to fully understand why. As mentioned previously, solving a block involves trying to get the cryptographic hash of the block to be below a certain value, and you do that by trying different random numbers at the end of the block. Once solved, the hash output is like a fingerprint that uniquely identifies that block. If even a single character in the block is changed, the block's hash would be completely different, just like we saw before when an additional period was added. The hash output, or fingerprint, is actually what's used as the previous block reference. One result of this is that there's no way to switch out a block in the middle of the chain, because the hash value for the new block would be different and the next block's reference would no longer point to it. And subtly, but even more importantly, a block cannot be solved before the previous block is solved. The previous block reference is part of the text that goes through the hash function, so any changes to it would require resolving. Getting back to Alice, this is why she can't pre-compute a branch. She can only start solving blocks once the block she wants to build on is solved and its hash value is known. She is therefore in a race with the rest of the network until Bob ships a product, which is when she wants to present a longer branch. One last question is whether Alice might be able to outpace everyone if she had an extremely fast computer or perhaps a room full of computers. But even with thousands of computers, she would be unlikely to win the race to solve a block because she isn't racing any one computer, but rather the entire network. You can think of it like a lottery. She can operate thousands of computers, or equivalently buy thousands of lottery tickets, but even then, it's much more likely that someone else would win. She would need control of half the total computing power in the entire network to have a 50% chance of solving a block before someone else, and much more to have a high probability of winning several blocks in a row faster. So transactions in the blockchain are protected by a mathematical race, one that pits an attacker against the entire rest of the network. A consequence of blocks building on top of each other is that transactions further back in the chain are more secure. An attacker would have to outpace the network for a longer amount of time to carry out a double spend attack, replacing a block further back in the chain. So the system is only vulnerable to a double spend attack near the end of the chain, which is why it's recommended to wait several blocks before considering received money final. One last comment on the blockchain before explaining the final pieces of the Bitcoin system. Amazingly, nothing described so far requires any trust. When you receive information from strangers in the Bitcoin network, you can check for yourself that block solutions are correct. And because the math problems are so hard, you know that there's no way any attacker could have generated them on their own. The solutions are proof that the computing power of the entire network was brought to bear. Now that we've discussed how money is transferred through digital signatures and transaction chains, and how the order of those transactions is protected in the blockchain, let's go over the final piece, where Bitcoins come from. To send money, you must reference a previous transaction where you were the recipient, but how do coins get into this ownership chain in the first place? As a way to slowly and randomly generate and distribute coins, a reward is given to whoever solves a block. This is why solving blocks is called mining, although its real purpose is to verify transactions and safeguard the blockchain. Every 4 years, the block reward is cut in half, so eventually no more coins will be released. About 21 million in total will be created. Bear in mind that you can send down to 1/100 millionth of a Bitcoin, so the total number available will likely not limit the currency's usability. Once the block rewards cease, what incentive will miners have to process transactions? In addition to the block reward, miners also get any transaction fees that can optionally be included with transactions. Right now, miners will include transactions with no fees into blocks because their main incentive is the block reward. But in the future, transactions will likely be processed in order of the fees attached, and ones without fees will likely be ignored. So sending money in Bitcoin will probably not be free, but will hopefully still be cheaper than current credit card fees. As mentioned before, on average, it would take several years for a typical computer to solve a block, so an individual's chance of ever solving one before the rest of the network, which typically takes 10 minutes, is very low. To receive a steadier stream of income, many people join groups called mining pools that collectively work to solve blocks and distribute rewards based on work contributed. These act somewhat like lottery pools among coworkers, except that some of these pools are quite large and comprise more than 20% of all the computers in the network. The fact that some of these pools are so large has some important implications about security. As mentioned before, it's very unlikely for an attacker to solve several blocks in a row faster than the rest of the network, but it is possible, and the probability increases as the attacker's processing power gains in proportion to the rest of the network. In fact, one of these mining pools, BTC Guild, has solved 6 blocks in a row by itself, and has voluntarily limited its members to ward off distrust in the entire Bitcoin network. Even with substantial computing power, the farther back in the blockchain a transaction gets, the harder it would be for an attacker to change it. The current recommendation is to wait for a transaction to make it into at least one block or get one confirmation before considering it final. And for larger transactions, wait for at least 6 blocks. In light of BTC Guild's ability to solve 6 blocks in a row, you might want to wait even longer. By design, each block takes about 10 minutes to solve, so waiting for 6 blocks would take about an hour. Compared to the several seconds a credit card transaction takes, waiting this long for a confirmation may seem burdensome, but keep in mind that credit card customers can claim a stolen card months later to have charges reversed from merchants, called chargebacks, so Bitcoin is actually much faster from a merchant's perspective. The particular choice of 10 minutes was somewhat arbitrary, but extremely short times could lead to instability and longer ones would delay confirmations. As more computers joined the network and specialized hardware is designed specifically for mining, the block solution time would get very small. To compensate, every 2 weeks, all the Bitcoin software recalibrates the difficulty of the math problem to target 10 minutes. For comparison, a similar digital currency called Litecoin has been able to operate with a 2.5-minute block time. In summary, Bitcoin is a mathematically protected digital currency that is maintained by a network of peers. Digital signatures authorize individual transactions, ownership is passed via transaction chains, and the ordering of those transactions is protected in the blockchain. By requiring difficult math problems to be solved with each block, would-be attackers are pitted against the entire rest of the network in a computational race they are unlikely to win. Bitcoin promises many interesting ideas, such as insulation from government meddling, anonymity, and potentially lower transaction fees. It also has many challenges, as it is currently very difficult to exchange Bitcoins for other currencies, and it has been cited as a haven for illegal activity and tax evasion, so governments may try to ban it. Also, the mathematical race that protects the blockchain uses a substantial amount of electricity.
The world is in financial disarray. Currencies failing, economies in wild flux, jobs being lost. But what if you could build an entirely new economy, one specifically designed for the digital realm? Well, that is the dream behind Bitcoin. Bitcoin is a decentralised electronic cash system that uses peer-to-peer networking along with digital signatures and cryptographics to generate currency. Now, with traditional money, think dollars, the euro, pesos, you've got a central bank, like the Federal Reserve. They issue the currency and they print more or less cash as needed, but not with Bitcoin. Bitcoins are generated using a process called mining. Your computer is given a complex mathematical problem to solve, and the goal is a 64-digit number. If your grey box can successfully solve that algorithm, then congratulations, you are the proud owner of a new block of 50 Bitcoins. The network automatically adjusts the difficulty of mining so that 50 Bitcoins are created roughly every 10 minutes. The reason they call it mining is because there's a set number of Bitcoins that can ever be mined in the system. There's only 21 million Bitcoins that will ever be created in total. You can't just print off cash like they do in the real world. You're digging it out of the system like precious metals from some mathematical mine. Right now, a Bitcoin is roughly worth $70 US. Last year, miners generated the equivalent of $16.7 million worth of Bitcoins, and we're only halfway down the mine shaft with over 10 million Bitcoins unearthed already. Like any economy, you don't want too much too fast because then the value of your currency drops, or so slow that your economy grounds to a halt. It's designed to be a self-stabilizing economy. Whether it actually is that way though, well, that is a little bit more complicated. Welcome to the exchanges. These exchanges allow people to buy and sell Bitcoins with each other. The largest Bitcoin exchange is Mt. Gox. And it's here that you can purchase Bitcoins using local currencies. You can even store Bitcoins too. Mind you, that can be a bit risky. Hackers have, on occasion, dangerously destabilised these exchanges. Bitcoin is also the currency that fuels what's known as the dark web. Using software called Tor, you can hide your identity online and access the digital marketplace they call the Silk Road, where sellers flog illegal drugs like LSD, heroin and marijuana. Buyers conduct all transactions using Bitcoin. The influence of Bitcoin is growing. WikiLeaks and WordPress will accept Bitcoin as cash. Even the ideas behind Bitcoin are already changing the way people think about cash. The Royal Canadian Mint have just launched MintChip, an electronic currency backed by the Canadian government that borrows a lot from the philosophy of Bitcoin. And ultimately, that is what's most powerful about Bitcoin. Not the coins itself, but the way it can change the way we look at, think about, and most importantly, spend our money.
Bitcoin, explained simply. This is Matthew. He works with online payment, and his grandmother, Margaret, has just begun banking online. She's heard of Bitcoin, but doesn't know what it is. Matthew can explain. Everyone knows about money. We use cash or cards to buy things, either in shops or online. Bitcoin works in a similar way, but is a completely digital currency. It is created and stored electronically. The banks control Margaret's money, whereas it's the users themselves that control Bitcoin payments. Her money can be affected by inflation, but Bitcoin can't. By controlling production, they keep their value on quite a solid level. This makes it popular in countries with economic problems, as users can circumnavigate inflation and other issues. However, even small events, such as a bad press report, can have a drastic effect on Bitcoin price. So, where could Margaret use Bitcoins? Certain companies and online retailers now accept it as payment. However, Bitcoin is still relatively unknown by businesses, as it's a developing network. The simple and largely anonymous nature of Bitcoins has also made it attractive to criminals in the black market. From Matthew's perspective, Bitcoin is an app on a computer or smartphone that works as an online wallet. It's easier to make payments than with conventional debit or credit cards. Just enter the recipient's address, the amount to pay, and press Send. Margaret can send and receive money instantly anywhere in the world and at any time. Unlike credit cards, there are either no or only small fees because there is no bank to go through, and no personal or sensitive data is stored. Users each have their own address from which they can send and receive Bitcoins. A collection or block of these transactions is then added to the blockchain, Bitcoin's equivalent of a bank's ledger. Users that maintain this form of accounting are rewarded with new Bitcoins. This is known as mining. There is a fixed amount of Bitcoins, but over time, existing Bitcoins become divided to maintain a consistent value. Now that Matthew has explained Bitcoins, Margaret doesn't find online payment to be all that complicated anymore. Bitcoin appears to be a real alternative form for worldwide currency for the future.
Feathers, shells, paper. Over the ages, we've used all sorts of things as money. But what makes money money? No, seriously. The question comes up as a new kind of currency, Bitcoin, is grabbing attention. This week, U.S. officials are outlining the perils and promises of Bitcoin in the first ever Senate hearing on it. Now, a lot of you are probably wondering, what really is a Bitcoin? Bitcoins are just another iteration of money for today's digital age. No printing press required. So where do they come from? There's no Ben Bernanke of Bitcoins, no central bank or government authority at all. The whole thing is underpinned by a computer network made up of users' machines. Bitcoins are mathematically generated by those computers as they execute difficult number-crunching tasks, a process known as mining. And mining gets harder over time. So the computer solves some tough math problems and accrues Bitcoins, which it stores on the computer or with a third-party service. The idea is that only about 21 million Bitcoins can ever be mined, but the value of them can swing wildly in the market. So what do you do with Bitcoins? Some people just sit on them, waiting for the market to rise. Others are using them to buy real things from people who accept them. You can get anything from food, services, you can even translate them into real currency. The anonymous nature of the network raises the question that maybe you can even buy something illegal. That's what's worrying some authorities. The feds think they may have caught a man called the Dread Pirate Roberts, accused of running an internet black market. It all sounds a little crazy, but some big names are getting in on the action. The Winklevoss twins, famous for their involvement in Facebook, say the Bitcoin market could one day be worth 10 times what it is now, and they put millions into the idea. So now we're back to that question. What is money? Money is money because we think it has value today, and we think it will have value tomorrow, and that we'll be able to use it as a medium of exchange. In other words, money is money because we believe in it. Clearly, all those who bought in believe that Bitcoin has value.
What is Bitcoin? Bitcoin is the first decentralized digital currency. Bitcoins are digital coins you can send through the internet. Compared to other alternatives, Bitcoins have a number of advantages. Bitcoins are transferred directly from person to person via the net, without going through a bank or clearinghouse. This means that the fees are much lower, you can use them in every country, your account cannot be frozen, and there are no prerequisites or arbitrary limits. Let's look at how it works. Bitcoins are generated all over the internet by anybody running a free application called a Bitcoin miner. Mining requires a certain amount of work for each block of coins. This amount is automatically adjusted by the network such that Bitcoins are always created at a predictable and limited rate. Your Bitcoins are stored in your digital wallet, which might look familiar if you use online banking. When you transfer Bitcoins, an electronic signature is added. After a few minutes, the transaction is verified by a miner and permanently and anonymously stored in the network. The Bitcoin software is completely open source and anybody can review the code. Bitcoin is changing finance the same way the web changed publishing. When everyone has access to a global market, great ideas flourish. Let's look at some examples of how Bitcoins are already used today. You can purchase video games, gifts, books, servers, and alpaca socks. Several currency exchanges exist where you can trade your Bitcoins for dollars, euros, and more. Bitcoins are a great way for small businesses and freelancers to get noticed.
Some of the earlier ideas of digital money simply took the form of a public ledger. You start off with money, you have a list of who owns how many coins, and then people call in and say, I hereby transfer so many coins to such, and you then update the ledger. Now, of course, in real life, proper money actually works like that. It's just that the banks don't keep an infinite publicly visible history of all the transactions. But Bitcoin keeps everything publicly visible forever. The basic idea behind Bitcoin is that you have got thousands of people called Bitcoin miners who compete to find the next hash in something called a blockchain. And a new hash is found about every 10 minutes. So what happens is that hundreds of people who want to do a transaction, say I want to pay you a tenth of a Bitcoin, which is about £25 or so, pay for lunch or a taxi ride or whatever, what I do is I sign a transaction saying that I pay you £25, and that gets collected together with hundreds of other transactions that people want to do around the world, and Bitcoin miners work on it. How they work on it is they look for a random number which, together with the last hash of the blockchain and the batch of pending transactions, will have a certain property. And this property is found only about one time every 16 million attempts. So you get thousands, in fact millions of computers around the world working to try and find the next hash with this special property by trying the existing blockchain plus all the transactions in the queue that are waiting to be processed. And eventually, every 10 minutes or so, some lucky person puts up his hand and say, "Found it!" And when that happens, he gets 25 Bitcoins. So that's the reward for that person for finding that particular hash. The blockchain is a list of all the transactions that have been done with Bitcoin back since the first transaction in 2008 or 2009. And it's punctuated with hashes, and each hash binds together the transactions that happened up to that point in time. And so anybody can look back over the blockchain and can trace the origin of any particular Bitcoin. When it was mined, right, when it was awarded as a as a prize to a miner who found an appropriate hash, and everybody who spent it or subdivided it or did something else with it since then. So it's an open ledger, and the history of every single coin is visible to all. What you basically do is you add to the blockchain basically one hash at a time. So you start off with the last hash plus all the transactions that you've swept together into a pool to add to the chain, and then there's the hash that you found at the end. It's also worth saying that miners tend to work in pools, and at present there are 3 large pools which distribute the work to tens of thousands of people who then beaver away happily trying to find the next hash. And when the reward comes through, right, and each of these mining pools will win a reward about once every half hour or so, they then share that out to the miners who work for them. So what you've ended up with is a system whereby people can buy Bitcoin mining equipment, they can plug it in, they can sign up to a mining pool, and they get a return on their investment, just as if they'd put money in the bank, although the return is at present slightly better. If you're actually paying for your electricity, half of all the return that you get on your investment is going to have to go to pay the electricity bill. There's a significant problem coming down the line because next year, about a year from now, slightly under a year from now, the reward for finding a Bitcoin is due to fall from 25 Bitcoins per successful hash to 12.5. Now, when this was set up, the inventor decided that in order to prevent inflation, the number of Bitcoins that you would get would fall over time. So the amount of work that you had to do per Bitcoin would increase until finally the amount of Bitcoin in circulation would be stable. Now, this means that from about October next year, if you're doing Bitcoin mining on a fully commercial basis, then every dollar that you spend on electricity will return only $1 in expectation in Bitcoins rather than $2 at the present time. So there's no way for you to recoup the capital cost of your equipment, unless of course you can place your equipment in places where electricity is very cheap or in college dorm rooms where it's free. And eventually college deans are going to start putting in electricity meters, and what then happens to Bitcoin?
So is this part of the way that Bitcoin works, is that these rules have been set up already, that over a certain amount of time these things happen?
Well, at present the Bitcoin rules were set up by the anonymous guy who set the system up in 2008. And they're maintained by the people who maintain the Bitcoin software. And so long as they agree on what the software should do, you have consensus. But if they were to disagree and fork the system into two separate universes, then that would have huge consequences, just like, for example, if Greece had left the euro, there would have been all sorts of trouble to mop up. Nobody knows for sure who wrote Bitcoin. The person who claimed authorship, Satoshi Nakamoto, appears to be a pseudonym, and various people have been found who might have been him. What we do know is that the first Bitcoin transaction was made with Hal Finney, who was a cypherpunk, a cryptographer and a coder who could definitely have invented this and come up with it. And he unfortunately died of motor neuron disease a while ago, so we can't now ask him whether it was his handiwork. He did deny it at the time. But in any case, somebody unknown, who may have been Hal, gave us this amazing and fascinating system. And as for where it goes in the long term, the answer is, I don't know. The blockchain is a truly wonderful technical innovation. It doesn't quite do what people like cypherpunks originally thought it would do, namely create a stable, anonymous currency that was beyond the reach of governments. And my feeling is that it hasn't quite found a killer application yet. If you think of the internet, for example, back in the mid-1990s, people thought that bringing the internet to the home would be absolutely great for basically delivering video to the home. So something like you get from your favorite video rental service or for your PVR was reckoned to be what people would use the internet for. And of course that turned out to be not its real application. The real application of the internet, as everybody knows, is disseminating photographs of cats. So what will be cats for Bitcoin? We don't know. And whoever figures that out might stand to make quite a few shillings.
At a very basic level, Bitcoin is just a digital file or ledger that contains names and balances, and people exchange money by changing this file. When Bob sells Carol a lawnmower for 5.2 Bitcoins, Bob's balance goes up by 5.2 and Carol's down by 5.2. There's no gold or government-issued money backing these numbers. Bob is only willing to trade his real-life lawnmower for a higher number in this digital file because he has faith that other people will also trust the system. So who maintains this ledger and makes sure no one cheats? One goal of Bitcoin is to avoid any centralized control, so every participant maintains their own copy of the ledger. One surprising consequence of this is that everyone can see everyone else's balances, although the real system only uses account numbers and not names, so there's some level of anonymity. If everyone maintains their own ledger, how are all the ledgers kept in sync as money is transferred? At a basic level, when you want to send money, you simply tell everyone else by broadcasting a message with your account number, the receivers, and the amount. Everyone across the entire world then updates their ledger. As a quick aside, I'm describing how Bitcoin works for power users, people who help maintain the system. You can also just use the system to send and receive money, though, without maintaining a ledger. If sending money is as simple as creating a message with some account numbers, what's to stop a thief, Alice, from spending Bob's money by using his account number? Like a pen and paper check, Bitcoin requires a kind of signature to prove that the sender is the real owner of an account, but is based on math rather than handwriting. When a new account number is created, it comes along with a private key mathematically linked to that account number. If you've heard of a Bitcoin wallet, these keys are what it holds and are what allow you to create signatures. To create a signature, a private key and the text from a transaction are fed into a special cryptographic function. Another function allows other people to check the signature, making sure it was created by the account owner and that it applies to that specific transaction. Unlike the handwritten version, these signatures can't be copied and reused in the future, as they're unique to each transaction. While the mathematical signatures prove who sent a transaction, they can't prove when it was sent, and this turns out to be problematic. In our traditional banking system, if Alice wrote 2 checks but only had enough money to cover one of them, the bank would pay the first person attempting to cash his check but refuse the second because Alice's account would be empty. So the order of these checks is critical because it determines who should get paid. Unfortunately, order is much harder to determine in Bitcoin, where instead of a single bank, there are individuals all over the world. Network delays might cause transactions to arrive in different orders in different places, and fraudsters could lie about timestamps. 2 recipients might both think their transaction is first and ship a product, effectively allowing Alice to spend money twice. Bitcoin prevents this by providing a way for the entire world to decide on transaction order. As new transactions are created, they go into a pool of pending transactions, and from here they'll be sorted into a giant chain that locks in their order. To select which transaction is next, a kind of mathematical lottery is held. Participants select a pending transaction of their choice and begin trying to solve a special problem that will link it to the end of the chain. The first person to find a solution wins and gets to have their transaction selected as next in the chain. So what's this linking problem? It's based on a special function called a cryptographic hash. As scary as this sounds, it just mixes up its inputs and spits out a number, but it's special because it's irreversible. There's no easy way to start with an output and then find an input that generates it other than by making lots of guesses. And this is literally what people are doing in Bitcoin, feeding this function random numbers until the output meets certain criteria. Besides a random guess, you also input a transaction from the pending pool and chain, which is where the linking part comes in. So the lottery provides a way for the entire world to decide which transaction is next, but the math behind it also helps ensure everyone agrees about past transactions too. Suppose you're joining the network for the first time and request a copy of the transaction chain to get caught up but receive several different versions. Which one should you trust? Ideally, you would trust the one that the majority of people are using, but determining this on the internet is difficult. What would stop a single person from voting millions of times? Bitcoin prevents this by requiring people to solve math problems to vote. This causes each vote to have a cost in computing power, making it unlikely that a single person or group could ever afford to outvote or outcompute the majority of users. The transaction ordering process described before actually provides the voting system. Part of the input to the linking problem is a transaction from the end of a chain, so each guess is effectively a vote for that chain. But how are all the votes tallied? Because the cryptographic hash function has well-defined statistical properties, you can look at any given answer and estimate how many guesses it took to find it, just like estimating how many coin flips it would take to get 100 heads in a row. So the links in a chain not only put transactions in order, but also act as an effective vote tally, making it easy to see which chain most people are using. Finally, how does money get created? Every time someone wins the lottery to pick the next transaction in the chain, new bitcoins are created out of thin air and awarded to their account. Solving these problems is commonly called mining, as this is how money enters the system, but the main purpose of the math is to make sure everyone's ledgers agree. The math simply provides a convenient way to randomly distribute money into the world. In fact, sometime around 2140, no more money will be created and participants will only be paid from fees added onto transactions.
What if there's a technological advancement so powerful that it transforms the very basic pillars of our society? A technology which fundamentally influences the way that our economy, governance systems, and businesses function, and could change our conceptual understanding of trade, ownership, and trust. This technology already exists, and it's called cryptocurrency. People often think of Bitcoin as only virtual money or a transaction system. But if you look closer, you'll see that the monetary aspect is just the tip of the iceberg. That's because Bitcoin is a groundbreaking internet technology for which money is merely one of the possible applications. Money exists to facilitate trade. Through the centuries, trade has become incredibly complex. Everyone trades with everyone worldwide. Trade is recorded in bookkeeping, and this information is often isolated and closed to the public. For this reason, we use third parties and middlemen we trust to facilitate and approve our transactions. Think of governments, banks, accountants, notaries, and the paper money in your wallet. We call these trusted third parties. This brings us to the essence of Bitcoin. Bitcoin software enables a network of computers to maintain a collective bookkeeping via the internet. This bookkeeping is neither closed nor in control of one party. Rather, it is public and available in one digital ledger which is fully distributed across the network. We call this the blockchain. In the blockchain, all transactions are logged, including information on the time, date, participants, and amount of every single transaction. Each node in the network owns a full copy of the blockchain. On the basis of complicated, state-of-the-art mathematical principles, the transactions are verified by the so-called Bitcoin miners, who maintain the ledger. The mathematical principles also ensure that these nodes automatically and continuously agree about the current state of the ledger and every transaction in it. If anyone attempts to corrupt a transaction, the nodes will not arrive at a consensus, and hence will refuse to incorporate the transaction in the blockchain. So every transaction is public, and thousands of nodes unanimously agree that a transaction has occurred on date X at time Y. It's almost like there's a notary present at every transaction. This way, everyone has access to a shared single source of truth. This is why we can always trust the blockchain. The ledger doesn't care whether a Bitcoin represents a certain amount of euros or dollars, or anything else of value, or property for that matter. Users can decide for themselves what a unit of Bitcoin represents. A Bitcoin is divisible in 100 million units, and each unit is both individually identifiable and programmable. This means that users can assign properties to each unit. Users can program a unit to represent a eurocent, or a share in a company, a kilowatt-hour of energy, or a digital certificate of ownership. Because of this, Bitcoin is much more than simply money and payments. A Bitcoin can represent many kinds of property: 1,000 barrels of oil, award credits, or a vote during elections, for example. Moreover, Bitcoin allows us to make our currency smarter and to automize our cash and money flows. Imagine a healthcare allowance in dollars or euros that can only be used to pay for healthcare at certified parties. In this case, whether someone actually follows the rules is no longer verified in the bureaucratic process afterwards. You simply program these rules into the money. Ergo, compliancy up front. The unit can even be programmed in such a way that it will automatically return to the provider if the receiver doesn't use it after a certain amount of time. This way, the provider can ensure that allowances are not hoarded. A company can control its spending in the same way, by programming budgets for salaries, machinery, materials, and maintenance so that the respective money is specified and cannot be spent on other things. Automizing such matters leads to a considerable decrease in bureaucracy, which saves accountants, controllers, and the organization in general an incredible amount of time. The programmable open character of Bitcoin allows us to completely rebuild and innovate our financial sector and our administrative processes, make them more efficient and transparent, and significantly decrease bureaucracy. But there's more. In an Internet of Things, our economy will be dealing with machines that actively participate in the economic traffic. In fact, they're already here. Think of a vending machine, or drones delivering packages. These machines are unfamiliar with the concept of trust, but Bitcoin is not. Because of Bitcoin, the drone can be 100% certain that it will deliver the package to the right recipient and know for sure that it's been paid for. And we can program the vending machine in such a way that it will automatically keep track of its supplies, order new supplies from the supplier, and pay for them automatically. Of course, you'll understand that this is only the beginning. Internet technology is disruptive and breaks the status quo. It opens markets and breaks the positions of middlemen all the time. Bitcoin and cryptocurrencies have caused a paradigm shift. It's time to explore this new technology constructively and critically, and openly discuss potential applications.
Welcome to NCIX Tech Tips. Today's episode is all about those cryptocurrencies that you've been hearing so much about. There are a ton of them floating around now. Everyone wants a piece of the pie, but the main ones are Bitcoin, Litecoin, Purecoin, Namecoin, and Dogecoin, and Catcoin. Actually, no, I'm just kidding about those last two. They do really exist. In fact, people are making money on Catcoin at the moment. But anyway, those four first ones are sort of the more relevant ones. We're going to give you a rundown about this cryptocurrency thing and what it's all about. So at the most basic level, these cryptocurrencies are really no different than the money that you have in your wallet. Similar to this money in my wallet, it has no intrinsic value. It's just bits of data, whereas this is just pieces of paper. You can't actually really do much with this other than like throw it in the air like a rap star or like, you know, strike menacing poses and hold large wads of it or whatever else you want to do. It also bears some similarity to commodities like gold or diamonds though, so there's no central bank that controls it. And keeping with that theme of no control, like gold and diamonds, it can be sent directly from user to user without any credit card companies, banks, or other intermediaries. Now, unlike, also similar to gold, but unlike the wrapped status paper, you can't just print a bunch of a cryptocurrency. They need to be mined. So at the heart of Bitcoin, for example, there is a mathematical problem. Users solve these problems with high-end computer parts. Graphics cards are better than CPUs, and beyond those are ASIC cards. And every time a solution to the problem is found, there is a reward given in the form of a Bitcoin. Now, the difficulty of this math problem varies with the strength of the network, so that the solutions are found at regular intervals, every 10 minutes on average. The reward also varies, the reward itself also varies, except it is tied to a 4-year scale, which started at 10.5 million coins in the first year and then will half. Now, eventually, we're going to reach the upper limit of 21 million Bitcoins, and after that, like gold, once we run out of it, we can't mine more. And the theory is that Bitcoins will become more expensive as they become more rare, and people eventually lose them. I mean, once you lose a wallet full of Bitcoins, those Bitcoins are gone forever. But don't worry, guys, there is a saving grace. Unlike normal currency that can only make smaller denominations like pennies and dollars, Bitcoins can actually be divided up to 8 decimal places. So 0.00000001 Bitcoin would be the smallest denomination of Bitcoin. That's how even with a Bitcoin hovering at, you know, anywhere between $500 to $1,500 Canadian, depending on the time of day and, you know, what's going on out there in the market, you can still just use a fraction of that to pay for a pack of gum, for example. It's not like, oh, well, do you have change for $700 for this packet? No, it's not like that. Now, the way that Bitcoins are stored is in a virtual wallet, which basically keeps a unique record of every single transaction and also allows you to send and receive Bitcoins. All transactions are also verified by the miners, and that record is permanently stored by all members of the network. So that means that transactions can take a few minutes in order to complete and verify that it has actually gone through. So that is the general idea behind Bitcoin and cryptocurrencies really as a whole, but what about all these other cryptocurrencies? We've mostly talked about Bitcoin so far. Well, there are 3 main ones: Litecoin, Purecoin, and Namecoin. Litecoins are the second biggest cryptocurrency right now, with the main advantage, I guess, being that they're a lot cheaper, they're easier to mine, and they're also about 4 times faster when completing a transaction. Speaking of them being easier to mine, Litecoin is also ASIC resistant, which means that ASIC cards and machines that are special pieces of hardware that are built simply to mine cryptocurrency faster is not that effective on it. Now, speaking of ASICs, let's talk a little bit about what those are. So for Bitcoin particularly, because it's not ASIC resistant, ASIC cards and machines are special pieces of hardware that are built simply to mine Bitcoin way faster than even the highest end consumer grade hardware. So to put it in perspective, the fastest video card produces between 1 to 2 kilohash, which is the unit of measurement for how quickly you can calculate cryptocurrency. So these dedicated cards, compared to 1.2 kilohash, can produce up to 1,500 gigahash at power consumptions that are much lower. Power consumption is one of the major
costs of mining Bitcoins, because you have to have the hardware working extremely hard. So essentially, Litecoins, when I say ASIC resistant, it means that they are much harder to make dedicated hardware for, and GPUs, graphics cards, remain the most efficient way to mine them. And that makes them much more accessible than the $2,000+ ASIC monster dedicated hardware. And in addition to that, you can actually use your graphics card for other things. So it's more for real people, normal people. Now, all the other currencies have their unique spin, but I won't bog you too much down with all of that. Just check out the description to learn more about them. But in summary, Bitcoins are a virtual currency, which, like we said, is not really that different from a paper currency. This is sort of virtual value as well. You can mine them with high-end computer parts or ASIC miners. There are a maximum of 21 million Bitcoins out there, 12 million of which have already been found, and all the transactions are publicly and anonymously stored.
What is Bitcoin? Bitcoin is the first decentralized digital currency. Bitcoins are digital coins you can send through the internet. Compared to other alternatives, Bitcoins have a number of advantages. Bitcoins are transferred directly from person to person via the net, without going through a bank or clearinghouse. This means that the fees are much lower. You can use them in every country. Your account cannot be frozen, and there are no prerequisites or arbitrary limits. Let's look at how it works. Several currency exchanges exist where you can buy and sell Bitcoins for dollars, euros, and more. Your Bitcoins are kept in your digital wallet on your computer or mobile device. Sending Bitcoins is as simple as sending an email, and you can purchase anything with Bitcoin. The Bitcoin network is secured by individuals called miners. Miners are rewarded newly generated Bitcoins for verifying transactions. After transactions are verified, they are recorded in a transparent public ledger. Bitcoin opens up a whole new platform for innovation. The software is completely open source and anyone can review the code. Bitcoin is changing finance the same way the web changed publishing. When everyone has access to a global market, great ideas flourish. Bitcoins are a great way for businesses to minimize transaction fees. It doesn't cost anything to start accepting them, and it's easy to set up. There are no chargebacks, and you'll get additional business from the Bitcoin economy.
It's been a strange year for Bitcoin, the stateless digital currency invented just 6 years ago that's now used for $50 million worth of transactions a day. Its price has swung wildly from over $1,000 at the end of 2013 to around $200 today. But despite the volatility, everyone from banks to stock exchanges and Silicon Valley technologists are starting to make bets on Bitcoin companies. Why?
I think when you see people investing in Bitcoin, it sounds like they're investing in the currency, but I think you'll find they're not really. The institutional money that's going in is going into the underlying technology, not the payment instrument itself. So investing in Bitcoin doesn't really mean investing in Bitcoin. It means investing in what they call the blockchain technology, which is the new technology that sits underneath Bitcoin.
The blockchain is essentially a giant record book of all Bitcoin transactions. It is to Bitcoin what the internet is to email, a big electronic system on top of which you can build applications. Currency is just one. The supposed benefit is that it takes away the need for trusted third-party record keepers like banks and replaces them with a system that relies on code breaking and the wisdom of crowds. Its advocates think it has the potential to be cheaper, more transparent, and more reliable. To understand how this blockchain works, I went to one of the places where new Bitcoins get minted, a data centre just outside London.
This is a Bitcoin mine. No rocks or gold nuggets in sight, but instead rack upon rack of special computers in a data centre. That's the hum you can hear from behind me. Companies use them running 24 hours a day to solve complex mathematical problems. And the prize? New batches of Bitcoin that get released every time a puzzle is solved.
The blockchain maintains itself by getting computers, known as miners, to take part in a game where transactions are almost a side effect. Like a poker player counting cards played, every miner keeps a copy of the whole blockchain so they can compete to decode the next round of transactions. When someone wants to transfer Bitcoins, they broadcast a message out to the network of miners with the details. Every few minutes, the system picks up bundles of these transactions and automatically wraps them up in a tricky maths problem. Whoever solves it first writes down the transactions in the blockchain and broadcasts the answer out to the other miners, who can check it is correct. The winner is rewarded with some new bitcoins, and the transaction involving the existing bitcoins gets processed.
Well, looking to the future, I think the technology has quite wide applications. It's hard to think of them at first because we're in an environment where most of our financial institutions are actually trusted and regulated. I mean, when I go and look at my bank account, I don't expect Barclays to have secretly changed it in the meantime. But there are a myriad of financial services all around the world where people don't have trusted and uncorruptible institutions and records.
Land registries, identity storage, and peer-to-peer stock exchanges are just some of the potential uses of the blockchain. But there are big risks. Over time, the cost of maintaining the blockchain will rise due to tougher regulation and the mechanics of the game, which means some of the most interesting applications may not be economical. Price volatility also makes market manipulation a concern, and competing non-Bitcoin related blockchains are springing up.
The Bitcoin price is important in one very specific way for the Bitcoin blockchain, which is the price provides an incentive for people to use their computers to maintain the blockchain and keep it going. And it's certainly true to say in the long run that is unsustainable. But that's Bitcoins and the Bitcoin blockchain. That doesn't mean there aren't other blockchains or other ways of incentivizing, I mean money is one of them, people to maintain blockchains.
The idea of independent competing computers that can agree on a definitive record instead of using a trusted middleman might be appealing, but it's unclear whether this blockchain could ever really separate truth from trust.
Imagine for a second that you are in charge of the task of inventing money. But you get this task today, not in the 12th century when money was initially invented. You're basically asked to find a way for people to exchange an agreed value between one another. I know it's hard, but try to think. If this was done today, would we really be using metal coins and paper for this? Perhaps we can find a better way? What if we wrote down somewhere, maybe in an electronic ledger, what value each person has? This way, we can keep track of how much value each person can spend. So if I, for example, do some work for you, you would probably give me some of your value in exchange. Let's name this value Bitcoin. But how will people be defined in this ledger? I mean, how will someone send me value or Bitcoins? I guess we will have to give each person a unique identifier or address. We will keep track of which address or person holds which value. These addresses are known as wallets. So we've decided to write down in our ledger which address or wallet holds which amount of value. This ledger is called the blockchain, and it keeps all of the transactions from the beginning of time. Now it's time to make sure that everyone follows the rules. How can we do this? How can we ensure that no one cheats and says that their address has more value than what they actually own? I know. We'll spread this ledger around to tens of thousands of people, so whenever someone wants to transfer some of his value in order to get something, we can check to see if his story adds up to what everyone else thinks. If he's good for his value, we will let him spend it. But why would these people want to carry this ledger on their computer? And who has time to verify all of this each time a transaction is made? Well, what if we rewarded people who did this with value? Hence, the miners were born. Tens of thousands of people who get paid in bitcoins for going through the ledger, making sure that everything is in order and that no one is cheating, including themselves. You've just invented a modern solution for money, and that's exactly what Bitcoin is. A digital, decentralized currency.
So Bitcoin is sort of one of these ideas that have been surrounded in mystery, the enigma wrapped in an enigma. Bitcoin is an ability, or it provides a way in which anyone around the world can transact with one another. They can send money, they can receive money without going through a traditional middleman, which is the bank, right?
So it's like invisible currency.
It is. It's virtual currency. I mean, virtual currency has been around for a long, long time, but Bitcoin is one of the most popular ways in which virtual currency has taken off. And underneath Bitcoin is what's called the blockchain. So every time a miner goes and gets Bitcoin, or this long string of letters and numerical and alphabetic letters, they then have currency, okay? And that currency and that particular blockchain is now changing the way that the financial services industry is looking at making transactions faster, smarter, and removing the barriers for average consumers. So I know this technology through a company called Coinbase, which has literally taken off. They've received millions of dollars investments from Andrew Easton and many other venture capital companies out there, as well as some of the traditional players on Wall Street. And I learned about the blockchain technology through Coinbase. I said, wow, I like their website. I like this concept that you can save money and you can also not have to worry about having that middleman, the bank, take a percent every time a transaction takes place. So I learned about it through Coinbase, and then I started to explore the underlying technology. What I found was a technology, this blockchain, could potentially change the way that third world countries transact, whether you're in Africa or in India, anywhere around the world, that you're able to send and receive money in a new way. And so that it was through Coinbase that I originally discovered them.
So since it's changing the way we deal with currency, do you think then they'll be around 20 years from now?
Oh, well, people attack Bitcoin all the time. I've been a skeptic myself. I don't use it for most of my transactions. I've used it here and there, with all candor. But I think some version, I don't think Bitcoin will be around, okay? I don't see it being the primary currency 20 years from now. I'll get a lot of flack for that, but that's what I believe. I believe blockchain, which is the technology underneath it, will be around.
Okay.
So that's why we ranked them on our website, angelkings.com. We ranked these startups, the financial services startups, we ranked the technology, not just another company like Coinbase. I don't think Coinbase will be around 20 years from now. That's why I wouldn't have invested in it. I think the valuation for it is way, way too high. But blockchain will be, and it's on our website as one of our top financial services startups.
And so then how are they going to build a community around the technology instead of the Bitcoin, since there's so much skepticism there?
That's a hard play. I mean, if you go to a venture capital group like ourselves at Angel Kings and you say, I've got another Bitcoin app or clone of another clone, I mean, I've been pitched many, many times, and my first idea is skepticism. Step away, I'm not interested.
Right.
But if you say, I'm building something on top of the underlying currency of a blockchain, then I get excited, because that's where the next 20, 30 years are going to evolve.
So then their timing, do you think they came in too soon with such a new technology?
No, I think the developers have stopped mining and now just developed toward blockchain technology. I believe there's a company, BlockEye, that a friend of mine is invested in, and it's more about the blockchain now than just the brand of Bitcoin. Bitcoin has been a little bit nebulous, as well as shaded by a lot of the bad transactions with the marketplaces that we've seen recently in the news. But the blockchain will preserve and will be a big thing 20 years from now. The strategy is that if one company brilliantly takes over blockchain, they could turn into a multi-billion-dollar company themselves.